Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we're going to cover the EIA show. There's a lot of things to digest and go through, given the fact that we did have a big crude draw, and what does that mean, and is it something that's going to continue or start to reverse next week? And then obviously in the second segment, we're going to go through in way more depth on what is refined product demand doing within the US. And then the last segment, we're going to go abroad and look at what is happening in Asia, because we've really been talking so much about Indian demand, Chinese demand, physical pricing, and we want to go through that in a bit more detail as to what do we think is going to happen over the next, let's call it the next 2 months or so. So just getting right into the WTI crude curve, the reason why we keep pulling this up is just because most of the US E&Ps talked about building out their balance sheet on 40-45. So right now I can hedge, and given there's prices, and so I'm just looking at 50. So when I say this, right now what is trading above 50, it doesn't mean you may be able to get the strike at the right price, but right now going out till June, July, depending on when you look, of 2023, I can hedge above 50. So when you're considering what are guys going to do, what are E&Ps going to try to create, this is where we start talking about and giving us some support for completion activity that we cover with the frac activity that we cover every Friday. Because right now, the E&Ps are doing what? They're hedging, completing, drilling. Because at this point, they're trying to really backstop that decline curve and start to build some momentum. Not that we're going to get back to some massive growth, but based on the current price deck, based on where you could possibly hedge, the fact that there's some guys that are going pretty, generating some cash, getting into the money in some locations, not all, not saying all of them, but this is going to be enough to help support where we currently are on the production line, and then where can we go over the next 6 months. And when we look at the next 6 months, we're thinking that if we can maintain this type of price deck, the NGL bucket, which we talked about on Friday, continues to go higher. It's been very well supported at above 20. We have more tightness in the naphtha market, the plastics market in Asia. Some of these things are pulling some of that liquids into the market, protecting pricing. Propane demand's through the roof. We'll talk about that in these segments. And again, these are things that are going to help support activity, and we're starting to see that now. Where do we think 11.3 is where we think we can get to with about 230 active spreads? But then as we get past that, that's when we really start to have a horsepower problem and that equipment problem in terms of just not having enough available. So when we look at, okay, well, let's take a deeper dive now into what is happening around the world with just regional indicators. And the reason why we show this now is just because we're trying to build that a bit of a broader summary. And here you can see China continues to push lower as they go further into Lunar New Year, which starts tomorrow. So a lot of individuals are already where they're going to be, just given the fact that there's going to be, events that happen throughout the weekend. So you can see that we really didn't get much of a spike. Europe has continued to, I don't want to say slow, but really just go sideways. North America's had a little bit of an increase, which has really been driven, kind of broad for the most part in terms of where we're seeing some activity. As we said last week, we expected Pad 5 to get a little bit better. It did. Pad 1 got worse just because of the snowstorms. So again, what we're seeing right now is a kind of that slow grind in North America that we've been calling for. So when we look at, next is always going to be what does compliance look like when we're talking about OPEC, because now we have Brent at 61.50. There's a lot of appetite to try to get this. The OSPs, or the official selling prices, have been taken a little bit higher in some locations or held fairly flat. When you look over the last 10 years, a lot of these increases, or even if there was an increase, it's still below what the average differentials are. So there's still some momentum to try to get some of this crude into the market, especially as we look at refinery crack spreads that continue to be under pressure, which we'll talk about in segment 3. So getting into the crude draw. So we had a big draw of about 6.64 million barrels a day. Once we roll in the SPR, it was a little bit bigger at about 6.81. Now this is interesting just because we had a drop in imports, but we had a drop in exports as well. So the question is going to be, okay, well, we had a drop in imports, we had a drop in exports. Based on where things sit right now, when we're thinking about imports didn't drop as much as exports. So there should have been a little bit of a difference, but that's where we start to think about, okay, well, is there a balancing factor we have to think about? And is that really created because we had too big of an increase in PADD 2 imports coming from Canada? That has to adjust. So some of these things are going to roll out. But again, it's still a bullish number in terms of the fact that we did have a draw. And you can see it was mostly driven by PADD 3 of that 4.54 million. East Coast was about a draw of about 1.1. The PADD 3 one is the one to watch because that has it's still the furthest over that year over year and 5-year average, and that's where they're trying to work through some of this excess in the market in this specific region. So, or is this going to start to adjust? So again, we had some fog today. I should say yesterday, that shut down the Houston Ship Channel for a period of time. That, the fact that it was only a short period, we shouldn't see too much of an issue. But again, these are things to consider. And then when we look at production was taken higher. We remain cautious are we at 11? The view is that we're probably still closer to that 10.9. But again, these are things to watch as we progress. And when we look at the oil inventories, as we exclude the SPR, you can see that we're still, working down. It's still a very gradual pace. And when we look at the average, it's counter-seasonal, which is a positive when we think about this pull-through of the system as some OECD countries continue to move some of their crude out of storage. And then when we in the third segment, we're going to talk about, well, what's in transit, what's on the water, and are we just having some stuff go from tanks into boats? And that's gonna just put the barrels in different locations. So here, when we look at PADD 3, again, we're slowly whittling down. It's just the pace remains fairly slow, and that's where we want to see this start to pick up. And now that we've gotten to a refinery throughput of about 83%, which is right where we thought it was going to be, this is where it's going to start to become a little bit harder, especially as we have those crack spreads remaining under some pressure. But with that being said, as we have PADD 3 drawing down, that is also pulling more crude out of Cushing, which is a net positive. The pace slowed a bit, but again, we're still moving in the right direction, getting this crude out of storage and into PADD 3. And whether that is going into the refiner or exports, it's still a net positive as we see that pull through coming into Cushing. Then when we look at in imports, you can see that we're down about 650,000 barrels a day, driven by PADD 1, 2, and 3. And as we said last week, we expected PADD 5 to get a little bit of a bump. Again, it's always going to come down to that timing. So as we come into this week, into next, we'll see PADDs 3 and 2 reverse. PADD 1 will still be a little bit slower. It should have a little bit of an increase, but again, it's still a little bit of a timing delay on the PADD 1 side. But PADD 2 and PADD 3 will start to see that pick back up, especially with some of the crude coming out of Canada into the Midwest. Then when we look at runs, again, 83% was right where we were considering. And as we were saying, PADD 3 we thought was going to be the big driver of that. So that puts us up 70 basis points at that 83%. And we think that we're just going to hold this line now, whether it be 83.5 or 82.5, as we go through the remainder of February. This is a very comfortable level given where we sit on refined products, and they still remain elevated, and gasoline's building quickly versus what we see on the oil side. So again, that balancing act. So then when we look at implied demand, this is what we were saying, where we were expecting we were actually expecting a bigger increase in gasoline, but the storm hit some of that demand that was expected. Distillate continued to be continue to be strong, as we were talking about trucking. That remains very robust. And then obviously we have a big cool down, which has pulled more heating oil into the system. Jet fuel Jet fuel looks a little odd. It's one that it could very well be a timing delay where there was a backstop and now there was some realization on what was moved through the system, because when we look at flights and we look at passengers, not much has changed. So remember, these are calculated numbers. So there's ways that this could have been a makeup number, or it could be carrying through, some big shipments that went out to essentially restock some airports. And then propane, again, propane is just going to remain very, very strong on a pricing level. When we think about what is happening right now, well, we have a big increase in heating demand, which is pulling through more propane, and then exports remain strong. So that's of no surprise as for anyone that's been following us and what we've been talking about with LPG and propane demand. So then when we look at floating storage, it came down a little bit, even though we had imports drop. Based on what we're seeing in the water, this is, again, that timing delay, and this will start to increase. And again, increase as in just follow the bottom of the cloud, not really going back to 5-year averages. But there's still going to be some deliveries that are going to show up, and it comes down to timing of when do you calculate it as floating storage. So this is one that's going to start to pick back up. Then obviously when we talk about imports, you can see that we're still following a trend that on that timing movement, but it's still at the bottom of that range. So and when you think about prices going higher, there's really no incentive to go out there and buy a sweeping amount. So again, there's just a matter of that timing as to when does these boats show up, just to maintain the API levels into the refiners, because remember, on the coast, you have to run between 33 and 34 API gravity, with the Permian being at 42 to 48, and the Gulf of Mexico being anywhere from, depending on where you are, 28 to about 34. So again, you need to bring from the offshore in order to try to backstop and provide that. So we'll always have imports. The question is always going to be how much. So here's a pretty big makeup number. As we were saying that we expected a spike last week, we just expected it to be within the top of the cloud, and instead it made that all-time high, seasonally adjusted high. Now, as we were saying, it's going to pull back, but we still expected it to outperform the 5-year average. We still maintain that. We just think it's going to now stay within the top of the range or the top of the cloud, as we do have more demand for the heavier crude coming out of Canada. Then when we look at the utilization rates, this is what we keep talking about, where we had a pretty steady increase. Now we're going to hold that 83 line, still well off average. And you can see that we stay fairly stable and then start to see that increase as we go into the summer months. And the question is going to be, how much of that increase do we actually see, given where we sit on summer gasoline, which we'll talk about in a bit more detail in the next segment. There's just the one caveat that we want to always look at is, where do we sit? What were expectations? And obviously expectations were for draw, not as big as the one that we had. So that is a net bullish component. But then when we look at imports, exports, exports are one that we remain concerned on, because again, we're getting to the end of what was sold when we had the Brent WTI, Brent LLS, Brent Magellan East Houston widen out. So now that we had some tightness coming back into the market, the question is going to be how much of this crude is going to start or continue to be supported, because we think that there's a pretty stable base of about 1.8 with those movements up and down, and we're expecting to see about 2.6 to 2.8 million on a more like when we average it out. That's what we think the average is going to be, and we were right on the nose with I think it came in about 2.64, which we'll talk about in a minute. And these are things to consider as we're looking at the data and what is the data going to say on the next few weeks.